Bob, it's a single-digit world. There's all the rationalization. There's interest rate parity, which I'm going to call a sophisticated strategy. I guess okay. And then there's the macro bet. How do you recover after 2019 on the macro side?
Well, 2018, I think, was a lesson learned. The tightening of central banks all around the world, it wasn't intended to cause a downturn, wasn't intended to cause what it did. But I think lessons were learned from that. And I think it was really a marker that we've probably seen the end of the boom-bust cycle.
Is it the end of the hedge fund business in modeling portfolios off the guesstimates of what central banks will do?
That won't play much of a role, nearly like as it has. I mean, you remember the 80s when we sat and waited for the money supply numbers. We've come a long way since then.
John, you have no idea how lucky you were to have missed this. 3 p.m. Thursdays, was it?
Yeah.
M1, M2, M3. Oh!
Traders literally betting on the number,
yes,
right?
Yeah.
But, you know, now we talk 25 plus, 25 minus. We're not even going to get 25 plus or minus, and we got negative yields. You know, that idea of the boom-bust cycle is, and that history that we've been in for decades is really driven by shifts in credit and monetary policy. But you're in a situation now where the Fed is in a box. They can't tighten and they can't ease, and nor can other central banks, particularly the reserve currencies. And so where do you go from here? It's not going to look like it has.
Bob, you've just said it twice, and I'm still surprised. And you said it before the interview started, and I'm still surprised. It's the end of the boom-bust cycle.
As we know it.
There was a man called Gordon Brown, the former Chancellor in the United Kingdom. There's
Walked by the other day.
A famous scene in Parliament of him standing up and saying, it's the end of boom-bust. And it was right before the financial crisis. As the end of the boom-bust cycle as we know it, what does that mean?
Well, as I said, the cycles in growth are caused by the boom and bust in credit. Credit expansion, credit contraction, and those expansions and contraction in credit are largely driven by changes in monetary policy. And so we're in a situation today where, with interest rates close to zero and secular deflationary forces, you're not going to get a tightening of monetary policy. They learned that lesson last year, got the unintended effects of that. You're not going to get a tightening, and one of the reasons you're not going to get a tightening is because they can't ease. See, if you can't ease, you don't want to tighten to cause the problem for yourself that you can't get out of, and therefore you're in a box. You don't tighten and you don't ease.
Sounds like you read Dalio's book.
Well, we work together.
Investment implications.
Yeah.
Let's talk about them. I mean, I can already see the headline. I'm sure a lot of people are engaged in everything you've just said. Let's assume what you say is true.
Yeah.
What are the investment implications, the capital allocation decisions? How have they changed?
Well, the nature of the economic environment is changing. And so we are converging on something, a slow growth environment, I'd say close to stagnation, approaching stagnation. And that's why interest rates are zero. That's why real interest rates are negative, is because central banks have to make cash very unattractive, as Ray was discussing, but also they have to make bonds unattractive. They've basically taken, central banks have taken cash and bonds, and they've made it a funding vehicle, not an investment vehicle. And they're trying to keep that rate low so that money goes from bonds to assets.
But I want to know what the changed behavior at Bridgewater is after subpar returns. And I don't mean you got to make 28% and own Apple, you know, become a majority shareholder of Apple. What I want to know is if you rationalize the hedge fund process is in a bull market not up 28%, but there's a number down there, a double-digit number that earns your fees and makes clients happy. How do you get back to that? What is the strategy, the investment execution to get back to the appropriate Julian Robertson Bridgewater return?
Well, cash is going to be a very unattractive investment intentionally, and therefore it's a funding vehicle. And so it may not be volatility. It may be stability. Stability could be opportunity, right? Volatility can be opportunity.
Okay, but if you write against that stability to make a premium to come in to boost your returns, you're naked to a jump condition. Do you and Mr. Dalio and your team worry about jump conditions which could upset the stability cart?
Of course, and particularly related to politics, particularly related to geopolitical conflict, but that will be, you will see, you'll hear the tremors before the earthquake. It won't just come upon you all suddenly. The volatility is out there, but it's not imminent. And so understanding today, the conditions today, What's the optimal response to those conditions today? And then a year from now, and then another year from then. What is the optimal response to those conditions at each stage is really our job to understand.
I'm thinking about markets and asset classes lined up right now, and I'm taking in everything you've said, and I'm thinking about the shifting opportunity cost of holding certain things based on your macro framework at the moment and for the foreseeable future. It just screams buy gold, doesn't it?
Well, that's one thing, but I don't think gold is not really like it's not a spike thing. But the environment that we're heading into, if you think about slow growth, stagnation, negative real interest rates, fiscal stimulation, monetization of those fiscal balances, the printing of money, gold is just the inverse of the value of money. And so as you print money, you raise the value of gold in money terms. And so that will be a secular move as well as a good inflation and crisis hedge.
So buy gold one, and now I want to talk about duration. What do you do with duration in the portfolio?
Well, it's very interesting. If you look at bonds relative to cash, they're not so bad. I mean, think about a zero interest rate funded at a negative 1.5% short rate is the same spread as a 14.5% bond yield funded at 13. So the spread to cash can still be good if cash is terribly bad, right? And so that's the equation. It's not the level of bond yields. It's the excess return relative to cash that's most important to us.
Do you have a confidence in 2020 that your interest rate strategy, the landmark Bridgewater approach, will sustain and deliver double-digit returns?
I think so, yeah. I mean, it's been a good year so far. But it's not from trading bonds long and short, right? And so it's from it's from the things that benefit from this environment. So, for example, we made emerging market currencies, high-yielding currencies, countries that have had severe balance of payments problems, inflation problems. They're in a situation today where they can get capital inflow, where that money goes from where liquidity is abundant and low yielding to where it's needed and high yielding. And also they have the room to cut interest rates, right? Because they don't have inflation, they've stabilized their currencies. They can cut interest rates to stimulate their economies. So there are really these three pockets of the world that you need to be thinking about. There's the reserve currency countries that have zero interest rates, and the U.S. is really in that bucket. There's the Asia, which is going to have a period of secular, pretty good growth, 6 to 8% nominal growth, funded at low single-digit interest rates. And then you've got the other emerging economies that I was referring to, the Brazils, Mexico, Turkeys, who have room to cut rates from a cyclical standpoint. So you have the secular of Asia, the weak secular of the developed countries, and the cyclical of the other emerging economies.
But let's talk about the weak secular of developed countries right now. We've seen the Japanification.
It's the reserve currency countries.
We've seen the Japanification of the European bond market. We've seen that. We haven't seen it as yet in the Treasury market. How are you thinking about those dynamics in the Treasury market at the moment? Do they carry over?
Well, it hasn't been required yet, but we're at 1.8% on the bond yield. I mean, think about it. If at a 2% inflation rate, the long-term average real interest rate is 2.5%. We should have a 4.5% bond yield now if things were normal. We got a 1.5% bond yield, and it just tells you it's not normal. So we're one downturn away from Europe.
If you're joining us on Bloomberg Television, Bloomberg Radio Worldwide, Bob Prince with us, Bridgewater Associates Co-Chief Investment Officer. I want to know the strategy. Your clients have to be upset with a single-digit subpar off year for Bridgewater. What is the strategy to get alpha, to use a general phrase, back, moving from this low rate, negative rate, whatever the mumbo jumbo is, to get back to normalcy? What do you affect as a strategy as we somehow move back to normal?
Well, first on the performance, our all-weather strategy was up 16 and 20. Okay. 16 in the U.S.
Very acceptable numbers.
And the alpha was flat. After the prior year, the alpha being up 14 and the beta flat. So there's been an oscillation between the beta and the alpha. Right? But to answer your question, our clients look to us to add value relative to whatever their benchmark is. And if it's cash, it beat that. And if it's equities, beat that. Our equity strategy was up 19.5% last year. We've beaten the benchmark for the last 2 years. So our job is to beat the benchmark, and I think we've added alpha 18 years in a row or something like that. We will make more alpha in an alpha-friendly environment, including down markets for us is an alpha-friendly environment, right? But up moves up and moves down is an alpha-friendly environment. But if it's not an alpha-friendly environment, we got to move into beta and earn that risk premium while you're waiting for that volatility.
Let's talk about where we are right now. We've got 3 minutes left in this conversation. I want to talk about credit. A little bit later on in this programme, Scott Minerd of Guggenheim's going to come on. Sent out a note to clients in the last couple of days, referring to where we were in the market almost as if it was a Ponzi scheme. I know people are worried about corporate credit. Spreads have tightened up enormously. Much worry about triple Bs and all of that stuff. Yet here we are with spreads on high-yield credit of in and around, what, 300 basis points? There and thereabouts. Where's this going?
Well, there's a desperation for yield all around the world and finding every possible way to get it. When you have money printing in Japan, and if you own Japanese bonds and you sell them to the BOJ, I'm going to turn around and buy what? Another Japanese bond? No, but an insurance company or bank can only buy a bond, and so they find whatever they can wherever they can find it, and they hedge it back into yen. So you've got an abundance of liquidity around the world, not just from the United States, but Japan and Europe, that finds assets anywhere in the world, and that's compressing spreads.
This boom-bust cycle, though, the thing that you said has finished, changed as we know it, what does that mean for credit when we look at where spreads are right now and say, well, historically, things are rich? Does the history matter anymore?
Well, anybody who bought a corporate bond because the yield was higher or lower than the average is not doing it the right way. I mean, history doesn't really matter, but it never mattered. What matters is the probability of default, the cash flow, the sources of liquidity, the risk premiums, the monetary policy. Those are the things that drive credit spreads.
Very quickly, this has been a wonderful discussion. It's been very insightful about the challenges of getting back to a good benchmark, and as you mentioned, the good equity response you have. Can you buy Apple and Amazon here? I mean, I just want to know, I'm behind in the market. Bob Prince, can you buy shares of Apple and Amazon here and be comfortable?
That's not our expertise.
I know, but
I wish we understood that better. I'll tell you what's mispriced.
What's mispriced?
Interest rates. Interest rates are purposely, it's not that assets are cheap. Assets are expensive. I can't comment on Apple or Amazon, but they all kind of follow the same path.
Yeah.
It's not that assets are cheap. It's that interest rates are low. Interest rates are unusually low for the level of economic activity, and they're set there intentionally to keep this thing going.